All right, 1 o'clock. We want to welcome everyone to today's webinar on the new tax legislation within the One Big Beautiful Bill Act. Nice mix of, looking at the attendee list, a really nice mix of kind of both individuals and families that we help. And also, some guests that are here to learn, which is great. So we appreciate you taking the time today. Really, Patrick and I were talking about it, but we've kind of built a large part of our firm just based off of education, and whether it's webinars or very early in my career, we were hosting tax planning workshops and social security strategy workshops, and a lot of you on the call here today remember those days, which is fun. Like I mentioned, also on the call, Patrick Gaul, a partner at our firm. Patrick's going to make sure I don't mess anything up, and is also here for a little tech help.
Yeah, if anybody's having a hard time hearing Johann or the not seeing him sharing his screen, just shoot us a quick email, info@oceansideadvisors.com. Or if you're currently a client, hopefully you guys are all familiar with the client dedicated email address. That'll certainly jump to the top of my inbox quicker than the info one will. So if you're having any difficulties, just shoot us a quick email and I will be monitoring that during the webinar.
Awesome. All right, and then you should also see a little question button that you can press throughout the webinar today. So my thought being, we will hopefully have a little bit of time at the end after we get through this, and if we don't, so my plan would be we will send you an email addressing your question if we run out of time, as we're wrapping up here. So obviously a lot of information in this new tax legislation. It's why it took me a couple weeks, obviously, to prepare. And actually, before I go any further, I better click to the next slide just so the attorneys don't get upset with me. So quick disclaimer, through this webinar, Oceanside Advisors does not render or offer to render personalized investment or tax advice. So the information provided in this webinar is for educational purposes only and does not constitute financial, tax, or legal advice. All right, so our goal today, what I would like to do is just kind of walk through so you can understand the financial planning changes and opportunities created through the One Big Beautiful Bill Act. You might hear me refer to that as OBA, is what I've been kind of hearing in other circles. So important for me to note here that what we present today is by no means exhaustive. Okay, so again, it's 870 page tax bill, and we've done our best to kind of go through and break it into some slides here today and some bullets that we think most impact the individuals and the families that we serve. All right, so with that being said, so some of the things we're going to look at today, which changes are permanent and which will so-called sunset. I changed my pointer option. Okay. And really just the difference in what that even means. Okay. What does permanent mean? We've received some questions on some confusion regarding permanent versus sunset. We'll look at the tax bracket updates, some changes to standard and itemized deductions, some really meaningful charitable deduction changes. Then we'll look into some of the Trump campaign promises that kind of the final versions that ended up in the bill. So the auto interest deduction, as well as deduction on tips and overtime, child tax credit updates, these new Trump accounts is what they're called, as well as some new qualified 529 expenses. We'll also discuss some business owner considerations, and again, then kind of hopefully have enough time for a little bit of Q&A. Right, so just to start, what does a permanent tax change mean? Okay, so as it pertains to tax legislation, what permanent means is a change in tax law that does not have a scheduled expiration. All right, so it doesn't have a scheduled expiration, meaning another administration could come in a handful of years here and change tax law, and all of a sudden the so-called permanent today is no longer permanent. Okay, so permanent, all that means is that it does not have a scheduled expiration. Conversely, some changes, and as we walk through all these, you'll see. I'll try to make it really clear, but conversely, some changes in the tax law, like they have a scheduled expiration date, and this is often referred to as a sunset. Okay, or just a handful of years where you might be able to execute on a certain strategy or deduction or tax credit. Okay, so this next slide, as I was preparing for today, like everything we're going to be going over in the following slides, it isn't going to be very helpful unless you have a basic understanding of how taxes are calculated, or just how they work. You really just need that basic understanding. And so this slide is going to be a wild oversimplification of the way taxes work. I know we have a couple CPAs on this call. They're going to laugh, but they're going to get it, of course. And so I just thought it was worth the time to just take a couple minutes to walk through the way taxes work in a very, very basic manner. So that way you can just have a better idea. Like this is itemized, this is standard, this is why it matters, and just kind of the way you flow through taxes. All right, so to start off, we have income. All right, so income can show up on a tax return in many different ways. W-2 if you're working, if you're an independent contractor, maybe a 1099, Social Security benefits, pensions. You can have income flow through, on the Schedule 1, maybe you have business income or rental income. Income is obviously going to find its way on the return. Okay, so that's kind of step one. And then what you have is from there, you start subtracting what's known as deductions for AGI. So sometimes this is better known as above the line deductions. Okay, and above the line, you'll see why in just a moment. But these are things like traditional IRA contributions or HSA contributions, student loan interest if you're below the phase outs. And so your income minus these above the line deductions, where you land here is adjusted gross income. And I have obviously the stars on the side there because this is a really important figure. And again, it's not even all the way to the bottom of page 1 of the tax return, but adjusted gross income is incredibly critical. And it's important you understand that because adjusted gross income is going to determine like things like Roth eligibility, that there's a slight modification to adjusted gross income that's going to determine like if you're Medicare age, like Medicare Part B premiums, right? Those are better, IRMA surcharges is what those are. Adjusted gross income, a modified form, is also going to determine if you aren't quite 65 yet, like Affordable Care Act, Obamacare subsidies. Different states have some different rules. AGI is also going to determine whether you qualify for certain credits, phase outs, things like that. So again, not even all the way to the bottom of page 1 of your tax return. Adjusted gross income is a really, really important figure that you understand. Okay, so once you have adjusted gross income, the next piece that you subtract is you either take the standard deduction or an itemized deduction. All right, so a standard deduction, for 2025, and we'll go into this in a little bit more detail, but with the new tax law, that the standard deduction, $31,500 for a couple, married filing jointly couple. There's additional deductions if you're 65 plus, which we'll get into. But main point, so standard deduction, or, all right, so it's one or the other, it's whichever is higher, or you have itemized deduction. Okay, now itemized deduction is going to be, there's a couple others, but these are the 4 primary components of your itemized deduction. All right, so we're going to be looking at things like mortgage interest, okay, medical expenses, but you'll notice they first have to hurdle. You have to get over 7.5% of, here we go again, adjusted gross income. So another reason why adjusted gross income is so important. So medical expenses have to exceed that 7.5% hurdle, and then they start getting added to itemized deductions. The third component here, state and local taxes. Okay, big change here, which we'll get into in the new legislation. There's a cap, right? So state and local taxes, better known as SALT. And then lastly, charitable contributions, which there are meaningful changes in the new tax bill to charitable contributions. Okay, so standard deduction or itemized deduction. So if the sum of the itemized deduction components does not exceed your standard deduction, right, you're going to end up on that left side. Okay, so we're going to deduct whichever these deductions from your AGI. And that's where we're going to land on taxable income. Okay. And then from there, you go, little schedule based on where you fall in the tax brackets, which we'll get to. You're not done yet, right? Because now you start subtracting tax credits, right? So credits, again, a lot of them are going to be based on AGI, going back up top. Things like child credits, energy credits, a number of others. And at that point, after subtracting your tax credits, that's where you're going to figure out, hey, like, have my withholdings throughout the year, whether that's right on the W-2 or from IRA payments that maybe you're withholding, or if you're sending in quarterly estimates, did those withholdings throughout the year satisfy the final tax bill? And that's where you figure out, I get a refund, or I get to send some money into the treasury. So that again, an oversimplification, but I think an important piece. So as we go through some of the slides, you can kind of think back to where these fit into this picture and where they might fall as it pertains to your specific financial plan. Okay, so starting just with tax brackets. Okay, so the TCJA, so that's the Tax Cuts and Jobs Act. So that was back President Trump's first term. These were set to expire, and one of the main things the new piece of legislation did was it made these permanent. Okay, so we know what permanent means now. So it made these tax brackets permanent with just some ever so slight adjustments. Particularly, so the 10% and the 12% rate, they are getting an extra inflation kind of jump, which will be nice for those of you that fall in those brackets in 2026. No inflation adjustment on the 37% bracket up top. Okay, so this is one way to look at tax brackets. All right, so as you just notice, sometimes this is somewhat difficult to conceptualize, which is why in our office, rather than looking at taxes like this, we prefer to look at taxes like this. All right, so this is known as a tax map. All right, if you've been working with our firm for an extended period of time, that this is going to start to look pretty familiar, right? So all we're doing here is, instead of looking at a chart, this is just a more visual representation of the tax brackets, right? So you're just kind of working along the x-axis. So you'll notice on the far left here, there's a gap from 0 to 31,500, which those are going to be your deductions. All right, so deductions are going to be on the left, and then it's going to push the entire tax bracket over to the right. And of course, as you earn more income, as most of you are aware, in the United States, progressive tax system, the more income you have, the higher you start going up the steps and paying more taxes at each level. Okay, so we're going to be coming back to these tax maps just because it's a nice way to conceptualize some of these changes in the new tax bill, as well as some planning implications that you're going to want to be considering. All right, so we want to also look at, so there's been a permanent increase in the standard deduction. All right, so 5% increase for all filing statuses. So again, Tax Cuts and Jobs Act, that was the previous kind of legislation in place. These were the figures that were going to be in play for 2025. And you'll notice that they've all kind of been bumped up roughly 5%. So 5% increase across the board here, where, so if you're filing single, $15,750 will be your standard deduction. Important to point out that many of you will recall that there's also an additional standard deduction for age 65 and up, and or an additional, if you happen to be blind, an additional deduction. Okay, so single $2,000 for that. So there's no change to those existing deductions. I'm sure many of you have heard that there's a new deduction on top of that for age 65, which we'll get to. All right, so on that point, so a new temporary, right? So this one is not permanent, but we do have a new temporary, an additional 65 plus deduction. Okay, so the new tax bill, individuals are going to receive $6,000 and then a $12,000 deduction per married couple. Important to point out that this begins now, right? So for the 2025 tax year, we have this new temporary additional deduction for those of you age 65 or older. Very important to point out for planning purposes, and we're going to go over this in more detail in the coming slides, but there is a phase out. So there is a phase out on these additional deductions. All right, so if you're married, as soon as you reach 150,000, you're going to start to get phased out 6 cents on the dollar for every dollar you go over. All right, if filing single, it starts at 75,000. All right, so and then so by the time you reach, you see the ranges here. So if you're filing single or head of household, as soon as income exceeds 175,000, you would totally be phased out from this deduction. You wouldn't receive any of the benefit. But important to point out, this additional deduction does not reduce your AGI. Okay, meaning Social Security, Medicare premiums, you're not going to get help on reducing those premiums from this deduction. And like I mentioned at the top, these are temporary. So these deductions are scheduled to sunset. So these will expire after the 2028 tax year. Of course, unless at that time Congress decides to extend them. Of course, that's a number of years out. We'll see what things look like at that time. Okay, so again, going back to tax maps, because again, I just think it's a much better way to kind of visualize, conceptualize changes. All right, so the left side here, this is the Tax Cuts and Jobs Act. So in other words, previous legislation as of prior to July 4th. All right, so we're looking at a single filer, age 65 plus, just to make the point. The left side, this would be a standard deduction, right? So we have, again, it was 15,000 plus the extra two that we already had. So that would be a $17,000 standard deduction for a single filer, age 65 plus. We move to the right. Again, this is the new tax legislation after the One Big Beautiful Bill Act. Now this same individual, we're going to move this standard deduction out to $23,750, which of course is going to be the new standard deduction, so $15,750. You still have the existing $2,000 deduction for being 65 plus, and now this new $6,000 deduction. Okay, this is also a good time though. You'll notice something new on the tax map. And again, if you work with us, you've seen these gray areas before, that they're about to get a lot bigger. But you'll notice that there's where the phase out begins. Like we saw on the previous slide, for single filers, that phase out starts at $75,000. Okay, so meaning once we start working past that phase out, we're going to have an increase in our effective marginal rate. This is where we're going to start to there's going to be a deviation between the regular tax brackets and what your effective marginal rate is. All right, and here's just a little bit more color on this. So here's just hypothetical example. Someone with $80,000, again, single filer, age 65 plus, 80,000 of ordinary income. Right, so the way this plays out, right? So if we're $5,000 over that threshold, we're going to start to get phased out. All right, so and really, the way that I saw this best stated is effectively for each $1 that you start going above this threshold, $1.06 is going to begin to be taxed at a 22% rate. Okay, so in other words, income that wasn't taxed at all is now getting thrown in there. So effectively, it kind of moves you from a 22% rate up to 23.35. All right, and so on the next slide here, I want to do a case study just to make a point. And so for just a moment, we're going to move away from the tax bill, because I think it's most helpful for retirees to understand. So retirees in particular to understand the way taxes actually work. Okay, so and I know CPAs will appreciate this because they see this happen on returns all the time. So I've called this the real tax system. So here we have a case study. Jane and John, married, filing jointly. They're both 65 plus years old. They have some nice Social Security benefits. Okay, so you have $90,000 of combined Social Security. That's a lot. That's definitely on the high end. We certainly have clients in that range. That likely means both worked a good part of their career, and likely one or both of them would have deferred benefits to age 70. Okay, so 90,000 of combined Social Security, and then they have 30,000 of net long-term capital gains. Okay, now I'm making an extreme example here to prove a point on the next screen, but this is just going to go to show how important it is that you understand the way taxes work and tax legislation, and I'm going to show a couple things on how the new bill even makes this more profound, how important tax planning is. Okay, so what if I told you that for Jane and John, you see these figures here, what if their tax map in practice looks like this? Okay, so all of a sudden, we've up to now we've gone over these nice, smooth, red, the regular tax brackets. This is real life. All right, so for many of you, it likely isn't this extreme, but it's probably in between, what we saw in some of the earlier slides and this. All right, so almost all of you are going to have a number of this gray. You call them shadow taxes. We're going to walk through the way this actually works. But maybe looking at what most people, when you look at this, gosh, right on the $50,000 mark, like how in the world are you paying a 52.95% effective marginal tax rate? Okay. And so I'm going to walk through why this happens just based on those figures. Again, so nice Social Security benefit, you have some long-term capital gains. This is how this happens. Okay. So nearly a 53% effective tax rate in that tax bracket. So how did this happen? Well, let's start with should it, intuitively should happen, right? So let's say you're right in that piece of that section of the tax bracket where shadow taxes are 53%, and you make an additional $1,000 withdrawal out of your IRA. All right, so what should happen? Well, you're in the, as you saw, the regular tax bracket, the red part, 12% bracket. So a $1,000 IRA withdrawal, the 12% bracket, yeah, that makes sense. You would owe $120 of taxes. Okay. But here's what actually happens. All right. So let's start with what we already know. $1,000 additional IRA withdrawal, 12% tax bracket, 120 taxes. Okay. But here's what actually the way things can play out. And we see this happen a lot with unfortunately retirees that they don't exactly know what's happening quite yet. Okay. So $1,000 IRA withdrawal, what it can do is it can cause additional Social Security to become taxable. All right. So Social Security, it can get taxed up. So 85% of it can become taxable income. So in this case, at that part of the tax bracket, that $1,000 of IRA withdrawal, it pushes $850 of Social Security to be taxable at the 12% bracket, which that's an additional $102 of tax due. Now you have $1,850 of additional income. And now that's going to cause capital gains. Right? So some of you will know that capital gains get taxed a little bit differently than ordinary income. So capital gains, in this case, that were sitting in the 0% bracket now just got bumped up to the 15% bracket. So all of a sudden you have a new $277 tax just on capital gains. Now this is where things used to end prior to the One Big Beautiful Bill Act, but now there's an additional shadow tax. Okay. And by the way, we call this kind of like a tax torpedo. You kind of see how it snowballs, because now in this hypothetical case, now what would happen is you would phase out an additional $111 of that $6,000 in their case, the $12,000, the additional deduction for being 65 plus. All right, so that's also money you're losing out of the 12% bracket. That's an additional $13.32. The torpedo continues where now it's going to push another $111 of capital gains to be taxable in the going from 0 to 15. Okay, so I think you're getting the point. $16 there. So you add up what actually happens on that IRA withdrawal, and a total additional tax burden in that case, $1,000 withdrawal, $529 of tax, which effectively puts you in that called the 53% tax bracket, which is pretty incredible. So again, point being, tax planning is going to be really, it's always been important, but now with these additional deductions and phase outs, and I only have time for so much today, but just tax planning is going to be really, really important post this One Big Beautiful Bill Act. All right, let's talk about the SALT. All right, so state and local tax, again, this is an itemized deduction, if you recall from one of the earlier slides. All right, so this is really a big push from representatives in higher tax states. All right, I know we have a number of attendees in different states. Here in South Carolina, it isn't quite as big of a problem, but yeah, in your Californias, New York, New Jerseys, and many others, they were really pushing hard for this. All right, so beginning this year, so importantly, 2025. This state and local tax increase, moving from, so it has been $10,000 all the way up to $40,000. All right, so a really big increase in itemized deductions for state and local taxes. So this is gonna be like income and property taxes. Okay. All right, so Important to point out, there's also a phase out for this as well. It doesn't start until $500,000 of adjusted gross income, and then it completely gets phased out between that 500 and 600K, right? So at 600,000 of adjusted gross income, you would be limited all the way back down to the $10,000 cap. All right. So in terms of shadow taxes, again, same idea. Big incentive to any way you can push yourself. So someone in these income range, this would be, gosh, make sure you're maxing out 401ks, other kind of profit sharing, maybe even a defined benefit plan, maybe start introducing if you own a business. Definitely some incentive to get income down below $500,000. This provision is not permanent, right? So it is set to sunset after 2029, in which it is scheduled to go back to the $10,000 cap. Right. Last bullet point on this: pass-through entity taxes are still allowed. Outside of the scope of today's webinar in South Carolina, this really doesn't matter, but in some states it does. So pass-through entity taxes, still allowed. All right, just another slide at the higher end of the tax bracket. There's also a limitation on itemized deductions. So beginning next year, 2026, those that find themselves in that top 37% bracket, you need to reduce itemized deductions by 2/37%. I know that sounds kind of funny, but effectively what that does is it caps the benefit of itemized deductions to 35%. And dare I say the government ever does anything elegant, but this is like a really elegant, creative way to create tax revenue for more wealthy people. So effectively, if you're in that top bracket, rather than getting a 37% deduction, you're actually just getting 35, which might not seem like a lot, but in that tax bracket, that's going to be a really nice source of revenue for the Treasury. All right, this is a big one. Okay, charitable deduction changes. All right, let's start with itemizers. Again, we have itemizers, and we have standard deduction, non-itemizers. All right, so for itemizers, there's a new 0.5% AGI hurdle. Okay, so similar to the way itemized works for medical, right? Remember, you need to exceed that 7.5% hurdle. Similar to that, now if you itemize, there's a new 0.5% AGI hurdle. All right, so just a really simple example. Let's say we have a taxpayer with an adjusted gross income of 200,000, and let's say they tithe 10% of their income. So let's say they typically make 20,000 of charitable giving on their Schedule A. Okay, so prior to this act, that whole 20,000 would be included in itemized deductions. Okay, but now we have this new 0.5% hurdle. Right, so step one's going to be what's a 0.5% of your 200,000 of AGI? So that's $1,000. Right, so $1,000 is going to be a 0.5% of 200,000. So now you need to get over that hurdle before your deduction begins to count. So in this case, how much are you over the $1,000 hurdle? Well, 19,000. Right, so a new hurdle for itemizers in your charitable giving. Okay, the other side of that, and this is really nice for non-itemizers. All right, there's a new $1,000 deduction if you're filing single, and a $2,000 deduction for those married filing jointly. All right, so many of you we've had this discussion in the office a lot over the last decade, but it's been unfortunate for many of you, particularly before you're age 70 and a half. Like, very charitably inclined and very generous and giving, but you've been taking the standard deduction, and while it's obviously the primary motivator of giving is out of your heart, but you haven't been getting a tax deduction. All right. So with the exception of, you're right around COVID, they did for 1 or 2 years, they had like a $300 deduction. But so this is gonna be really nice because now they've opened up a window for non-itemizers where you will receive a deduction now for your giving, which you can add to the standard deduction. Which I have a little sub bullet here, and we'll be talking about this with clients that this applies to, but this can potentially change strategy for some, not all, for some of age 70 and a half that are making qualified charitable distributions out of your IRAs. Again, in our office, we talk a lot about QCDs. They become particularly powerful once you reach required minimum distribution age. All right, so definitely something we'll be looking at in our office here in the months ahead for each of you. Okay, and now we're going to move into some of the other campaign promises. So first we have the auto interest deduction. All right, you'll note that this is not permanent. Right, so again, another one of these provisions that is we expect to sunset unless it otherwise gets extended in the future. All right, so the auto interest deduction, a cap of $10,000, which if you actually take a step back and think about that, you'd have to buy a really expensive car to have $10,000 of just interest in a year. Right, in a single year, that have to be a really expensive car. So I think that cap is pretty safe for most. A couple important points. In order to qualify for the interest deduction, it must be a new car and it must be assembled in the United States. All right. It has to, this deduction is available to both itemizers and non-itemizers, which is great. Important to note, they also phased out here. Okay, there are phase outs beginning at $100,000 for modified adjusted gross income for single filers, and then $200,000 for those filing jointly. No tax on tips overtime. All right, so another provision that is not permanent. All right, so again, we have this, 2005, 6, 7, 8. So 4 years of so-called no tax on tips overtime. Technically, it's not no tax, it's more of a deduction. All right, so we'll talk about both of these briefly here. All right, so starting with tips, a deduction up to 25,000. Importantly, because they're already kind of setting guidelines here, in order for it to qualify, the tip, it must traditionally and customarily receive tips as of December 24, which is smart that they did it that way, right? So it's so you can't just create a new job and say, hey, half of this is salary and the other half is going to be through tips, right? That's not the way it works. So it must be a job where tips have been a way to be paid for a long time. Right? So that deduction up to 25,000. And then not just that, but it also, it can't come from a specialized service, trade, or business. Right. So we're actually going to touch on SSTB a little later. Specialized service, trades, and business. Our firm would be included. We just don't get many breaks. I know CPAs feel the same way, but we'll touch on that on the QBI section. Okay, moving to overtime. All right, so deduction for single filers up to 12,500. Okay, in bold here, of overtime paid for excess payment above the regular rate. All right, so in other words, Yeah, so if the regular rate is $20 an hour and overtime gets you to 30, you don't get the whole $30 an hour deduction, right? It's just going to be the spread between the regular rate and the excess. So it's going to be that $10 an hour. All right. And then importantly, the second part of this sentence, and it has to be required, the overtime has to be required by the Fair Labor Standards Act. So this FLSA. Meaning like you can't well, similar to the tips. Yeah, but what the act did, that they're preventing new businesses to come and just create compensation that is really just a huge tax loophole. Okay, because the FLSA, even like from what I've heard, a lot of the unions aren't happy about this because the unions are going to be exempt from this FLSA, meaning the union overtime pay isn't going to qualify for this. So deduction for single filers up to 12,500, and you see below. So married filing jointly, you can get the full $25,000 deduction on your overtime. Third bullet point's an important one too, right? While this is a deduction, in terms of Fed tax, you're still going to have to pay FICA, so into Social Security and Medicare up to that limit. And similar to many of the other provisions, you'll notice a lot of these income phase outs apply. So $150,000 modified adjusted gross income for single filers, and $300,000 the phase out begins for married filing jointly. Child tax credit, pretty straightforward, but increased. So up to 2,200 beginning this year. I should have pointed that out at the beginning of the webinar, but it's kind of important to know, which ones start this year, some start next year. There's a couple towards the end here that don't start till 2027. So keep particular, close eye on when some of these start. But the increased tax credit begins this year, 2025, starting next year, indexed to inflation, which is always nice. And the credit phase outs were also extended. All right, so single filers receive that credit, and you aren't phased out all the way up into 243,000 of income. Married filing jointly, you don't get phased out at all until your income exceeds 400,000. So that's great. Lastly, refundable portion of the credit unchanged. So just like it has been, $1,700 in 2025. All right, this slide will be encouraging to some parents, grandparents. I know that we help that care a great deal about their grandchildren's education and so forth. So expanded qualified 529 expenses. And maybe I should start by saying, one of the hesitations that we see in our office just with people contributing to 529s, it's like, what if my kid doesn't want to go to college, or if my grandchild ends up not going to college, right? And so a lot of headway was made in the previous tax bill, but this tax bill, they've really expanded what you can use 529s for, which in my opinion is really, really nice. So now K through 12, you could really use 529 funds for a number of things, K through 12, in addition to tuition. All right, so beginning in 2026, all right, so next year, now you can use 20,000 a year out of a 529 for K through 12. Okay, so if you recall, like currently that's 10,000 that you can use per year for K through 12. Of course, once you're in college, it's basically unlimited. But for K through 12, this year it's 20,000, but beginning in 2026, that's up to 20,000 a year can be used out of a 529. This can be for public, private, homeschool expenses. Next one, tutoring outside of the home. You can use these for curriculum, books, standardized testing. And then all types of even therapy are being included in the physical therapy, occupational, behavioral, speech language. So just a number of other pieces, other things that 529s can now be used for, and considered a qualified expense. Not just K through 12, but even post-secondary credential expenses. So maybe you're after college, you're looking to get into a field like ours, and yeah, like a CFP, a CFA, you have CPA, you have continuing education exam fees. All these things are now eligible for 529 expenses, which is great. Okay, Trump accounts. These are interesting because these changed like kind of these have changed a great deal from kind of like the first version of the bill. And those of you that watch our little Monday video we do, this is exactly why we don't spend a lot of time analyzing like previous versions of the bill until uh, we get the final, because things just change so much. All right, so Trump account. So here's the final version of the bill, and again, we're still going to need more clarity on this. So bear with me here, but all right. So for one, like these are not starting until 2026, and like I mentioned, we're still going to need a lot of clarity. I think Patrick just saw. I think you said July 1st of next year was maybe. I think you saw in an article there. Is that
Yeah,
right?
yeah. I
We were just
most
talking about that
recently
today.
read like the earliest to expect these by would be July of next year, just given what the custodians have to go through to get situated.
Yep, which makes sense. It obviously must be a minor in 2026, and then what it sounds like is up to $5,000 a year in non-deductible contributions that can be contributed to the child's account. And then this additional, $1,000 a year for the next handful of year that is going to be put in accounts from the government. Okay. Again, not exactly sure how this is all going to play out yet, but some other kind of rules: no distributions allowed out of the account before the beneficiary that the child reaches age 18. The investments must be in a US equity fund. All right. So yeah, that's, I guess, good in some ways, but I know our office would argue like sometimes diversification is important, right, Patrick? Yeah, it's this year. Like but yeah, nonetheless, post age 18, once the beneficiary reaches age 18, most standard IRA rules apply. Okay, meaning like, that there would be exemptions for first time home buyers, things that you'd be able to get money out. Okay, so like I have a lot of thoughts on these accounts, uh, and just we need more clarification because like from what I understand, so a non-deductible into the account means that your contribution is after tax dollars, meaning the only taxable part of the account becomes the earnings. What would be like so that the earnings would be like pre-tax. So in other words, whenever the withdrawal happens, the contribution, because there's no deduction, it's that would come out tax free, but then the earnings would get taxed pre-tax, right? Because it's pre-tax, so earnings become pre-tax. But yet more guidance, because like my first question is, and I read somewhere else, like, can you convert these to a Roth? Because like in my eyes, this looks a whole lot like a potential backdoor Roth IRA for kids, which if it plays out that way could be super powerful. Again, I don't know if the IRS will let us do that, but essentially that's what a backdoor Roth IRA is, right? You're funding an IRA, a non-deductible IRA, and if they let you convert it to Roth like right away, again, we'll see the way um this plays out. But yeah, So once we have more information on the Trump accounts, because the alternatives, of course, to a Trump account for kids, right? Like, so you have, standard, like a custodial Roth for kids. You have 529s, or you have like UGMA UTMAs. Okay, so just like as I was kind of looking at this and like, what are the pros and cons between like a potential Trump account and the other common accounts that we see for kids. And so if you think about a like a minor like Roth or traditional IRA, like the problem there is you need earned income from the child. With this, you don't anymore. Okay. With custodial accounts like an UGMA or an UTMA, one of the downsides of an UGMA UTMA is, after you exceed like the kiddie tax threshold, that account begins to get taxed at the parent's rate, which that can be quite tax inefficient. And so if this continues to be taxed at the kids' rate, like that would be a positive. And then of course on like the 529 front, I mentioned with the earlier comment, one of the hesitations is, well, what if my child or grandchild doesn't use it for any educational purpose? Where obviously like this account would be more flexible. So just a lot we still need to learn a lot, and this is just going to be one of those where you just need to weigh the kind of the pros and cons and what makes the most sense for your family, your kids, your grandkids. But definitely something to be maybe looking at in the years ahead, particularly if the government's going to throw in $1,000 for free. Like at the very least, like it needs to be considered next year. So. All right, some business owner considerations. So those of you that are business owners, that this will likely ring a bell to many of you. But so maybe the biggest one for many, the Section 199A deduction, better known as QBI, has been made permanent. All right, so 20% of QBI deduction. The House version of this bill was much more favorable to many. It went to the Senate and really got watered down a lot. But yes, these are the final rules. The House version had QBI deduction up to 23%. They also had the threshold higher. The phase out threshold remains basically what it was. And third bullet point there, as it pertains to 199A deductions, still, this non-specialized service, trade, and business, like if you're not SSTB, like you receive way more favorable tax treatment, which I know, firms like ours, the accountants, doctors, lawyers, we don't benefit, which is unfortunate, but I don't make the rules. So still, the non specialized businesses continue to receive the more favorable tax treatment. Right, 100% bonus depreciation extended for qualified property, as well as some additional manufacturing incentives and enhanced tax credits for semiconductor firms. Right, so for a lot of the business side of planning, this is where we work really closely with the CPAs on the business side, as well as bookkeepers and so forth. But certainly on the business side, you're going to want to be aware of some of these updates. And again, this is not exhaustive. I wanted to get this on one slide here. All right, just a couple other random One Big Beautiful Bill Act changes. Most clean energy vehicle credits will be expiring in 2025, 2026, right? So if you planning on getting a vehicle or some kind of energy improvement in your house, you're going to want to get that done ASAP if you're hoping to get the credit. Again, work with your tax preparer, CPA, because some of those are expiring like really soon here in 2025. To the best of my knowledge, I think all of them are phased out by the end of 2026. So be cognizant of that. Second bullet point, educator expenses are allowed as an additional itemized deduction beginning next year, which I think it's great. I'm not sure why that hasn't always been the case. I think before there's like a $300 deduction, but yeah, if a teacher is coming out of pocket, that's not reimbursed. Like I feel like that makes a lot of sense that they should be able to deduct that. Alternative minimum tax exemption phase out threshold is lowered to $500,000 for single filers. That's 1 million for married filing jointly. Those of you that this pertains to, you'll understand this bump zone that effectively is about a 42% rate if you're in that phase out area. All right, so for very high net worth, ultra high net worth, the gift and estate tax threshold has been increased to 15 million per person beginning in 2026, right? So that means 30 million for a married couple, right? So kind of thinking back to the election, just to kind of show a lot of people were really concerned that perhaps that exemption would get moved to 5 million or even 3 million, and so some people are pretty happy about that. There's also been modifications to gain exclusions for qualified small business stock. A lot of kind of detailed rules there outside of the scope of today. And then, like I mentioned, kind of two bullets here, things that don't begin until 2027. But so first off, up to a $1,700 tax credit. So again, tax credit, that's a really nice one, because if you recall, that one's way down on the bottom of the way taxes work. So a $1,700 tax credit for contributions to scholarship granting organizations. So unless they change something here, like, I mean, it kind of seems like a no-brainer. If you're going to owe $1,700 of taxes anyway, you could either pay it to the government or give it to some granting organization that you like, that you think is going to be a good steward of those funds. So it's, I don't know, if I have the choice of giving the IRS 1,700 or some organization that I trust, like, I'm going to pick the latter. So if it's as obvious as that, what it says in the tax bill, like, I think that'll be a good idea for many of you. And also beginning in 2027, some new incentives for qualified opportunity funds. The kind of tie in opportunity zones and things which are, again, a little bit outside of the scope of today. Okay. Oh, actually, I did better on time than I thought. Okay, so got just a couple of minutes here. All right, so in summary, kind of bringing up the tax map of just that example that married couple with Social Security and capital gains, like this is a lot. This is a lot. Like, if taxes weren't confusing enough, like, after this bill, I would argue even more proactive tax planning is going to be necessary and helpful. So we would certainly encourage you to work closely with your team of professionals, with your accountants, your CPAs, estate attorneys, and your financial professionals as well. And so to that point, Roth conversions, tax loss harvesting, tax loss or gain harvesting, charitable giving, like you need to pay special attention to the income phase out ranges, right? Because if you're not aware, you could be right on some of these cliffs, these shadow taxes, and it could make a really big difference in your tax bill. So so kind of 2 points to understand. You really want to understand those phase outs, but even more importantly, like, you need to think a little. We would encourage you to think like a little bit bigger picture. You can't just think single year. You need to be thinking multiple year, like a multi-year tax strategy. Because like, a great example is someone, and we've seen this before, where someone will come to our office and that they're just starting RMDs, and that they have a multi-million-dollar pre-tax, like, IRA, SEP IRA or 401k, and they say, well, I've been trying to minimize taxes every year, the last handful of years. And it's like, well, you've done that, but now you kind of have a pretty big tax torpedo that's coming at you in these required distribution years now. And so just point being, like, a lot of times, you don't necessarily want to pay the lowest tax liability this year. You want to kind of think about this tax map in multiple years. You kind of need to stack them up and take advantage of navigating through what's going to, you're attempting to create the lowest lifetime tax bill should be the goal. So let's say, yeah, 2 o'clock. So we got to go. But but fall reviews, of course, begin in just a few weeks here, which we are really, really excited for. Those of you that work with us already, of course, everything that we've gone over today, we're going to be reviewing and addressing how each of these may or may not impact your financial plan. And if you're not on, if you don't work with our team and you're on the call here, certainly we've hoped that you have found it helpful. And if you ever want to have a quick call just to see if we might be able to help in an area or two, we would love to do that as well. So questions. Yeah, we have a lot of questions. Okay, so the plan on these questions, I want to be respectful of everyone's time because it is 2 o'clock. So all the questions in the queue here, we will send an email. We'll just email you personally to answer all of these. But again, really appreciate everyone taking the time to join us today. And hopefully this wasn't overwhelming. I know we're such nerds here. Like, we think this is kind of fun. But we're wishing everyone a really nice afternoon. And looking forward to seeing many of you soon. So thank you so much.